Hey everyone, welcome back to the channel. This week, the markets were all about central banks, fresh inflation numbers, and a new wave of tech and media shockwaves. Today, we're going to talk about the end of quantitative tightening, the latest inflation data, a global bond scare, Europe sliding again, India cutting rates, and a big wake-up call for the digital economy. So let us start with the biggest story of the week, because it is a real regime change moment. On December 1st, the Federal Reserve officially stopped shrinking its balance sheet. In other words, quantitative tightening is over, and the central bank is now simply rolling over its treasury holdings instead of letting them run off after cutting rates 3 times since September. That move came after months of stress in short-term funding markets and heavy use of the Fed repo facilities, which told policymakers that bank reserves were getting uncomfortably low. At the same time, the Fed quietly pumped more than $10 billion of liquidity into the system through overnight repo operations as the new regime kicked in. That does not sound like classic money printing, but for markets it feels like the brake is coming off and the car is finally coasting again. You could see it in the way risk assets reacted, from growth stocks to small caps and even parts of the crypto market. But here is the key point. This is happening while inflation is still above target and economic data is noisy because of the long government shutdown that just ended. Some online commentators are already hyping a massive liquidity-driven rally into 2026, while others worry that the Fed is easing financial conditions into a still sticky inflation backdrop. So for us as investors, the end of quantitative tightening is bullish for liquidity in the short term, but it also raises the stakes for every single data release and every rate decision from here. The second big story this week was the delayed inflation and spending data that finally dropped on Friday. After weeks of waiting because of the shutdown data blackout, we finally got the numbers for September, and they hit right in the middle of the debate about whether the Fed should cut again next week. The Fed favorite inflation gauge, the PCE index, showed prices running at about 2.8% year-on-year for both headline and core, basically flat compared to the previous month and still above the 2% goal. At the same time, consumer spending slowed to around 0.3% month-on-month after several stronger months, a clear sign that higher rates and higher prices are biting into demand. Markets absolutely loved this mix of still manageable inflation and softer growth. Futures now price an almost certain quarter-point rate cut at the Fed meeting on the 9th and 10th of December, and stocks rallied into the end of the week with the main indexes hovering just below record highs. Small caps in particular ripped higher, as investors bet that lower borrowing costs will finally give the more domestically focused, highly leveraged companies some breathing room. But here is what matters for us. Beneath the surface, layoffs announced this year are the highest since the pandemic, and unemployment has quietly crept up to around 4.4%, even as weekly jobless claims just hit a 3-year low. So, the tone in markets is cautiously optimistic, almost euphoric on the surface, while the real economy is sending very mixed signals. That tension is exactly why this PCE report feels like a green light for one more rate cut now, but also a warning that the window for easy money and painless growth is closing. While equities were partying, the bond market spent the week sending a very different message. Long-term yields in the United States and Japan pushed higher again, and in Japan the 10-year government bond yield touched its highest level since 2007. That spike in yields hammered the Nikkei at the end of the week, quickly erasing earlier gains as traders started to price in a real chance that the Bank of Japan could hike later this month. At the same time, U.S. Treasury yields bounced around the 4% level and the curve continued to steepen, a classic late-cycle signal where markets start to worry more about long-term debt supply, fiscal deficits, and inflation risk than about near-term growth. Now, here is what matters. Rising global yields are happening even as investors expect another Fed cut next week and more easing in 2026. That tells you that the peak rate story is not the same thing as a simple, clean bull market in bonds. In the transcripts from popular finance channels this week, you hear the same split view that we see in the data, with some voices cheering the chance to buy long-dated bonds on sale and others warning that the bond market is quietly tightening financial conditions all over again. For us, this is a reminder that the so-called Christmas rally in stocks is riding on a bond market that is far from calm, and that any surprise in inflation or growth could turn this gentle steepening into a real scare. The fourth big driver this week came out of Europe, and it was not a cheerful one. New data showed that Eurozone manufacturing slipped back into contraction in November, with the region-wide factory PMI dropping below the 50 line and hitting a 5-month low. Germany and France were especially weak, with their factory readings sinking to 9-month lows as new orders and exports fell again. Manufacturers across the currency bloc responded by cutting jobs at the fastest pace since the early stages of the last downturn and burning through inventories to protect margins. The only silver lining is that overall inflation in the bloc is now close to the central bank target, which means no one expects a quick rate hike from here. So what does this mean for global markets? First, it reinforces the idea that the growth engine of Europe is sputtering just as the United States is slowing, and China is struggling with its own structural problems. Second, it adds to the narrative that the current market optimism is heavily driven by U.S. tech and U.S. small caps, while a big part of the world economy is quietly rolling over in the background. For investors, that supports the case for staying selective in overseas equity exposure and being very careful with highly cyclical European names that depend on strong industrial momentum, because that momentum simply is not there right now. On the positive side of the global story, India stole a lot of macro attention this week. The Reserve Bank of India cut its main policy rate by a quarter of a percentage point to about 5.25%, and at the same time announced up to $16 billion equivalent in liquidity support through bond purchases and a big foreign exec. Hinge swap. In Hinge swap, the striking part is the backdrop. India just printed economic growth above 8% for the latest quarter, while inflation has fallen from over 6% last year to near zero. And the central bank still talks about this as a Goldilocks window where it can support growth without stoking runaway prices. Equity markets took the move in stride, with local indexes edging higher and the currency only slightly weaker as investors focus more on the growth story than on the small rate cut itself. Now, here is what matters. In the same week that Europe is cutting factory jobs and the United States is wrestling with delayed data, shutdown scars, and a messy labor market, one of the world's biggest emerging economies is easing policy from a position of strength. That is why so many institutional investors and online commentators are talking about a structural shift in capital flows toward India and away from slower, more indebted regions. For us as portfolio builders, it highlights how uneven this cycle has become, and why simply buying a global index may not be the best way to capture where the real growth and policy tailwinds are. The last big theme for the week was the collision of tech infrastructure risks and aggressive digital regulation. On Friday, a major cloud and security provider suffered a large outage that briefly took down or disrupted huge parts of the internet, from workplace tools to social platforms and design services. The company later explained that a flawed firewall update knocked out roughly a quarter of its global traffic for about 25 minutes while it rushed to patch a broader software vulnerability. Around the same time, regulators in Europe hit a large social media platform with a nine-figure fine under new digital rules, sending another clear signal that big tech business models will face tougher scrutiny on content, data, and competition. And in media, headlines about one of the biggest streaming platforms moving to buy the core studios and streaming assets of a traditional entertainment giant reminded everyone that consolidation in the content world is far from over and that regulators will be watching closely. Let us break this down. In just a couple of days, investors were reminded that our entire digital economy depends on a small number of infrastructure providers, and that a single software error can briefly shake everything from remote work to trading platforms. At the same time, the wave of antitrust and digital law enforcement is starting to carry real financial penalties that could reshape margins and cap some of the most aggressive growth assumptions in tech. The overall equity market shrugged off these stories in the short term, staying focused on rate cuts and liquidity, but for long-term investors, these are exactly the kinds of structural risks that can suddenly matter when sentiment flips. That is why, even in a week dominated by optimism about easier money, it still pays to think about resilience, regulation, and concentration risk in the background of every portfolio choice. Now, zooming in on the SPY, we finally answer the question left hanging from the news chapter: if liquidity is roaring back, does price action actually confirm the frenzy? And wow, this chart is screaming acceleration. The trend stack is widening with close above the 20-day, above the 50-day, above the 200-day, which tells us the impulse phase is alive and kicking. The slope of the 20-day average is steepening fast, showing that short-term momentum is no longer drifting, it is surging. At the same time, the RSI exploded higher today, rising far more aggressively than its 5-day rhythm, which is exactly what you see when buyers flip from cautious to full-on FOMO mode. So this is where things get wild. We opened with a bullish gap and never looked back. A classic gap and go pattern that holds its power only when traders are in a mood of boundless euphoria. The coast landed in the top 80% of the day, a sign of relentless dip chasing even though volume was shockingly thin. Thin volume at new highs is the kind of cocktail that makes seasoned traders nervous because it whispers that conviction is missing even as price levitates. But here's the twist. Low volume and a melt-up can persist for days, especially when everyone is waiting for the Fed next week. So the SPY is telling us the upside impulse is accelerating, but the foundation under it is light as air. And that combination is exactly why this market feels both unstoppable and fragile at the same time. This brings us back to the question we raised with SPY. If the broader market is shifting into a strong upswing, which stocks are really leading the move? One clear candidate is Alphabet, trading under the ticker Google. The chart looks remarkable for a megacap. For 9 sessions in a row, the share price has been holding above its rising trend channel, sitting almost 4% above the upper boundary as if pullbacks simply don't apply. That upper band, which normally acts as resistance, has turned into support, something you usually only see in phases of outright euphoria when every small dip is bought immediately. Since early April, the stock has spent more than 70% of the time inside this rising channel, with only a few genuine breakout moves. Even so, this current run is already one of the most extended stretches since the April surge that briefly pushed the price more than 8% above the channel. The daily ATR is sitting at around 41% of the channel's width, which tells us that the day-to-day swings are still well contained within the broader uptrend. In other words, the move is stretched but not disorderly. That's why traders keep debating whether Google is simply overbought or truly leading the next wave of liquidity into big tech and AI. Elon Musk has recently warned that AI data centers could soon run into electricity supply constraints, and that kind of headline perfectly captures the narrative energy driving this rally. With prices still hovering far above trend, Hardly anyone wants to step aside, because the fear of missing the next explosive leg up is stronger than the fear of a correction. At the same time, the big question from the last scene becomes unavoidable. If leaders like Google are blasting above their channels in a wave of boundless euphoria, why is no one hedging? The answer is right here in the VIX, the volatility index, which has been pinned near the bottom 18% of its yearly range for 9 straight sessions. This is the market's version of a sleepy lullaby, a moment when traders slip into a dreamlike comfort and start believing nothing can go wrong. So, the chart shows volatility crushed to levels that almost dare the bears to show up. The message is simple but chilly. When the VIX hugs these lows for this long, it usually means positioning is stretched, confidence is overflowing, and fear has left the building entirely. So, traders are leaning into upside bets without hesitation because the tape feels tranquil, maybe too tranquil. And yet anyone who has lived through real market shocks knows that prolonged calm is often the prelude to sudden chaos. So, as we ride this wave of optimism into next week's Fed decision, the VIX is whispering that the crowd is dancing on thin ice even if the surface still looks perfectly smooth. At the same time, the question everyone had after seeing the VIX pinned to the floor was simple. If fear has completely evaporated, where did all that risk appetite go next? It went straight into crypto, and the move was nothing short of explosive. Bitcoin, the ticker BTC, pulled off a violent shakeout early in the week as prices flushed below short-term support, triggered a cascade of stops, and made the market feel like a trapdoor had opened under traders who were swimming in boundless euphoria. Then came the snapback. Buyers stormed in with pure FOMO energy, launching BTC back toward the low 90,000 zone, with a kind of velocity that only appears when liquidity is thick and conviction is thin. So, the irony is that this entire whipsaw perfectly mirrors the mood we saw in equities. Everyone is leaning bullish because they think the Fed will keep flooding the system, but no one wants to admit how fragile the underlying structure still is. Musk even chimed in, joking that Bitcoin looked like it was trying to outrun its own shadow again. So, when you step back and look at the chart rhythm this week, the message is unmistakable. Crypto is acting as the emotional amplifier of this market cycle, magnifying every surge of euphoria and every dose of fear that traders refuse to show on the surface. So, heading into next week's data and the Fed meeting, BTC is the wild card that could either ignite the next leg higher or remind everyone how quickly momentum can evaporate in a market running this hot. Now, zooming in on GLD, the ticker for gold, we answer the question that crypto's chaos just raised. If Bitcoin is the emotional amplifier, where do traders hide when the frenzy feels too close to the sun? Gold has been quietly gliding inside its rising trend channel for 16 straight sessions, sitting in the 90.5 percentile of its range, just 0.7% below the upper band. That upper band has been respected 9 times and was touched again today, acting like a magnetic ceiling that buyers keep pressing into without quite breaking through. So, what makes this setup fascinating is the asymmetry baked into the channel. There is only about 0.7% of room to the upside, but nearly 6.5% of space to the lower band, which tells us the reward to risk is tight even as the crowd keeps piling in because rate cut bets are fueling a sense of boundless euphoria. The daily ATR is only about 17% of the channel width, meaning the structure is tight and any real breakout would require a surge of range that simply has not appeared yet. Musk joked earlier in the week that gold was acting like the adult in a room full of hyperactive assets, and that is exactly what this chart shows. Gold is trending, disciplined, and still holding near the top of its lane, but it is doing so with the calm confidence of an asset that climbs when the world feels tilted. So, as we move toward the Fed meeting, GLD sits in a position of controlled strength, reminding everyone that even in a market overflowing with risk appetite, the most ancient safe haven still knows how to command attention. This ties back to the question gold just raised. If safe havens are firm and crypto is chaotic, what is the bond market whispering beneath all this boundless euphoria? The TNX chart, which tracks the 10-year yield, looks deceptively calm, but the signals are anything but gentle. Today's trading range was crushed to just a sliver, 94% smaller than the average of the past 10 days, the kind of range compression that always feels like the quiet breath before a storm. So, that tiny range hides a more important clue. Sellers managed to drag the yield to close in the bottom quarter of the day's span, showing that even in a week where risk appetite is overflowing, bond traders are subtly leaning defensive. This matters because every time yields coil like this, the next move tends to be sharp, emotional, and highly reactionary to whatever macro catalyst hits first. Musk joked earlier this week that bonds were acting like a cat crouched under a couch right before it bolts, and honestly, the chart agrees. So, the message from TNX is simple, but ominous. Calm is not stability. Calm is tension awaiting release. And with the Fed meeting just days away, this compressed setup could easily become the spark that snaps markets out of their dreamlike confidence. We have to ask the obvious question after watching yields coil into a razor-thin range. Where is the pressure being released? The DXY chart, which tracks the dollar index, gives us the answer with a slow but persistent slide that mirrors the market's boundless euphoria. The dollar has been drifting inside its falling trend channel for 8 straight sessions, sitting roughly 0.7% below the upper band and about 1.4% above the lower band. That narrow corridor, only about 2.1% wide, shows how tightly the structure is wound. So, traders are watching every tick, because the channel has been respected again and again, with 10 touches on the upper band and 11 on the lower, reinforcing the idea that the downtrend is disciplined, not chaotic. The daily ATR at 19% of channel width tells us breakouts will need a real surge in energy, something we have not yet seen, even as global macro forces lean harder against the dollar. With the Fed preparing another rate cut and liquidity flooding into risk assets, the dollar's soft posture is fueling the very euphoria that keeps equities levitating. So, if yields snap and the dollar accelerates its slide, we could see a feedback loop that amplifies every risk trade heading into the final stretch before the Fed meeting. Now, zooming into the bigger macro question triggered by the sliding dollar, how do all these cross currents shape the next major move for global markets? Traders watching bonds, metals, and currencies side by side can feel the tension tightening, even beneath all the boundless euphoria on the surface. The TNX compression hinted at an imminent volatility burst, and the dollar's softening trend amplifies that signal by feeding liquidity straight into risk assets. Gold is holding near the top of its channel, crypto is whipping traders into emotional extremes, and equities keep floating as if gravity were suspended. That cocktail tells us the market is leaning heavily on the belief that the Fed will soothe every wobble. The problem is that compressed yields and a disciplined dollar downtrend often precede sharp macro inflection points. Traders know this pattern. Musk even joked that the entire risk complex is acting like a balloon being inflated in slow motion, everyone watching, no one stepping back. The takeaway is simple. Beneath the calm charts and the dreamy highs sits a market that is tightly coiled across multiple asset classes, and once a catalyst hits, the release could be fast, loud, and impossible to ignore. Now, zooming in on the SPY one more time, we answer the big question that all the earlier macro tension raised: is the market actually positioned for a clean continuation, or are we skating on a razor-thin edge? The chart shows SPY sitting inside its rising trend channel for 7 sessions, hugging the lower half of that structure with only about 0.4% of room above the lower band and nearly 2.8% of space up to the upper band. That huge asymmetry screams opportunity to the crowd that is already overflowing with irrational frenzy. So, even though the position sits in the 11th percentile of the channel, traders see the upside potential and barely acknowledge the downside risk. The channel has been respected again and again, with 9 touches on the upper band and 4 on the lower, the last lower touch just 1 day ago, which reinforces the idea that support is still alive. The daily ATR near 37% of channel width tells us the range is balanced, neither exhausted nor explosive, giving bulls a reason to stay confident. So, with the Fed just around the corner and the entire risk complex leaning into boundless euphoria, SPY is positioned for a potentially dramatic reaction. If the upper band breaks, the melt-up narrative gets new fuel. As the lower band snaps, the dreamlike calm could vanish in an instant. At the same moment, the question everyone is wrestling with becomes crystal clear. What do we actually do with a market that is floating in boundless euphoria while every major asset class is coiled for a potential volatility burst? The SPY chart we just examined showed how fragile the balance has become, and this final scene is about turning that tension into a game plan. Traders this week kept leaning into upside exposure because the narrative of endless liquidity feels irresistible, but the signals from yields, the dollar, and volatility all hint that the next catalyst will decide everything. If the Fed delivers exactly what markets crave, the melt-up can extend in dramatic fashion. If the tone shifts even slightly, the air under these elevated prices could thin out fast. The smartest move now is staying nimble, respecting trend channels and letting the market show its hand before making oversized bets. Boundless euphoria is fun until it isn't, and the next few sessions will reveal whether this rally has real fuel left or if traders have been dancing on borrowed momentum.